Hi guys, welcome back to my YouTube channel. It's so good to have you back here. If this is your first time on this channel, my name is Adireke Lawal. I'm a legal practitioner. I practice as a capital market solicitor and I'm also a personal finance tutor and expert. What do we do on this channel? We talk about proper money management and personal finance, anything related to investment, what to invest in, how to invest, where to invest, anything at all. You're on the right channel. Before we get to the cocoa of this video, I want to ask anyone who is here to subscribe, what are you still waiting for? Like, why are you stalling? Because the updates I'm about to be dropping on this channel, I don't want you to miss out. I want you to get your money up ASAP. So back to this video. This video is a sequel to my last video. If you're here to watch, please watch. In that video, we discussed how to choose the right stocks by studying a particular company's fundamentals. And by fundamentals, we examine how the company makes money, their competitors, and reading through their financial statements. But in this video, we are basically focusing on technical factors to determine the right stocks to buy. And we are talking about the PE ratio, the earnings per share, and also price to book ratio. All these valuation ratios, that's basically formulas that you can use to determine whether a stock is overvalued or undervalued. And if it is undervalued, it means that it has potential to go beyond its current price. And when it is overvalued, you know best not to buy when a stock is overvalued, because it means that it can potentially drop. Let's start with the first one, PE ratio. PE ratio is simply price to earnings ratio, and it's a formula developed to determine how much investors are willing to pay for a dollar or naira of a company's earnings. The formula is simply dividing the share price by the earnings per share. If your result from this calculation is very low, it's a sign that the stock is undervalued and it might be a good buy given other factors. On the other hand, if your result is very high, it may mean either of two things. One, that the stock is overvalued. Two, that investors are willing to bet on the high growth potential of the stock. Let's look at this example. So the current share price for Dangote Cement as at the time of making this video is 425 naira, and the earnings per share is 35.75 naira. These figures can be gotten online. You will divide the share price by earnings per share, which is what gave us 12.02. Currently, the stock is trading at a fair value. So another important formula that has been developed to determine the value of a particular stock is what we know as earnings per share. As the name implies, earnings per share. This simply means how much profit a company derives from 1 unit of shares. The formula is simply deducting preferred dividends from net income divided by weighted average of common shares outstanding. So basic EPS is equal to net income minus preferred dividends divided by weighted average of common shares outstanding. Your results determines the profitability of the company. The higher the EPS, the higher the company's profitability. Also, we have the price to book ratio, which is also known as the PB ratio. The price to book ratio simply compares the company's current stock price to the value of the company's asset. So the formula for PB ratio is simply share price divided by book value per share. This formula simply shows how much you are paying for each 1 naira of the company's net assets. For example, if a stock has a PB ratio of 1, it means you are paying exactly what the company's assets are worth. A PB below 1 means the stock is overvalued, while a high PB could mean that investors expect the company to grow or it may be overpriced. So it shares some similarities with PE ratio. Another technical indicator to consider is beta. Beta simply determines the stock volatility compared to the overall market. If the beta of a particular stock is 1, it means that the stock volatility moves with the market. If it is less than 1, it means the stock is less volatile. And if it is greater than 1, it means that it is highly volatile, which means the prices go up and down. I know you must be stressed listening to all of this, especially if calculation is not your strength. However, the good news is that there are different AI tools that can help you. One example is ChatGPT. You can task your ChatGPT to find the PE ratio, the price to book ratio, the earnings per share, beta, or dividend yield of a particular stock by just giving it the name of the company, and that is it. Alternatively, you can just consult financial experts for the right stocks to buy rather than just go through the stress of finding companies to buy. For a certain fee, you can get good stock recommendations from financial analysts, personal finance experts like myself, or stockbrokers. I have an investment club known as the YFP Millionaire Club, and it's essentially a club where we rub minds together on things to invest in. And every now and then, I drop in the latest investment opportunities, be it stock recommendations or the latest commercial paper listing or bonds. And every month we do an audit such that everybody discloses where they are on their financial journey. Essentially, we are not disclosing how much we are investing, but just that, oh, this is where I'm putting my money in, this and that. So it's just to keep everybody accountable, to encourage one another. If you enjoyed this video, kindly like, comment, and subscribe. When you subscribe, you help us reach more audience and also encourage us to do more educative videos. Bye.